Right. So managing shareholder firms, shareholder value, and the agency problem, which are terms that you may well not know, but I'll address and explain them as we go through. So rather like the online learning materials, there's kind of like a grouping of themes, or the subject, we present it thematically, as to say, one of the dogs has got a squeaky toy. I'll be back in a minute. I'll cut that bit out. So we present the subject as being a series of themes. So present it thematically, so linking, or trying to take the. It's an inductive subject. Okay, so we take data that's observable data, and out of it we lift out of it themes and theories. Okay, so I don't think that there's a strongly predictive theory base to it yet, but there are some strong themes that are based on observations of data. So it's empirically brought out. So we're starting with stuff that we can see, and then we're drawing some conclusions from it, sort of common practices or commonalities. And one of the things that we are very much drawn out of, and this will be a current refrain, I think, throughout quite a lot of the remaining topics, or the remaining lectures and materials. We're talking about corporations, or the managers of corporations, compete in stock markets to deliver shareholder value. What do I mean by shareholder value? Can I talk, or you can chat in your answer? What do I mean by shareholder value? Price of shares. Anything else? Earnings per share. What earnings per share in terms of what? Earnings per share is a ratio. Stock growth potential. Potentially, yeah, I suppose so. Dividend returns, yeah. So when we talk about shareholder value, is that we're talking about returning of value, or it might even be extraction of value back to shareholders through either gains on share price or through dividend payments. Okay, so I mean, this sort of like challenges the notion that firms are profit making, or they prioritize profit making, or market share and so on and so forth, or the economic fundamentals of the business, if what you're doing is that you are prioritizing shareholder value, because as we'll see, is that one doesn't necessarily lead to the other one, which is interesting. But what we have seen, certainly in the last since 2005 onwards, I would argue, is that we've seen that firms, and I'm talking about giant firms now, we're talking about the global firms, because this is a program about international business, so we're talking about the global multinational corporations, the giant firms. Giant firms are increasingly competing against each other for shareholder value, which means that there's kind of like a bifurcation in where they're focusing their efforts, and we'll talk about that in a minute. And as a consequence of that, and these things have an impact upon each other, in actual fact, is that investors, which are shareholders, fund managers, individuals to a lesser extent, but we're talking about institutional investors, are really focusing for highest yields. So they're searching for high yields, because if you are a professional investor, your job is to make money, is it not? Either for self, or for organization, or for bank, or for whatever intermediary you're working for. And as a consequence of that is that a dollar invested here or a dollar invested there, you'd make the choice upon where am I going to get my yield? What's the highest return I'm going to get? And also you think about it in terms of timeframes as well. And so this idea about maximization of shareholder value in firms with dispersed ownership. When we talk about dispersed ownership, we mean with shareholding. So it's held by shares. That means it's dispersed rather than a person holding the stock, or is the only owner, the owner entrepreneur, you know, that sort of thing. This goes against that idea of the owner operator. Is that with dispersed ownership is both prescribed by mainstream corporate finance books and consultancy firms as a solution to the agency problem in corporations where ownership and control of capital are separated. And recently, shareholder value primacy is being criticised by lots of business leaders as well as by politicians. I'm going to just to leave that one with you, really, as I'm not going to touch upon that too much, and unless we start to, I may draw upon it later on. But it's whilst there is some criticism of shareholder value from the likes of BlackRock, say for instance, I struggle to take that I struggle to take it seriously, in that BlackRock are a big fund management company that get their returns out of shares and shareholder value. To say, you know, we should be focusing upon other things, I find it slightly disingenuous, possibly what might refer to as a sincere lie. Anyway, so we need to talk therefore about the agency problem, in that there's an idea that actually efficient firms generate high share prices, okay, or high returns for shareholders. And as a consequence of that is that low share prices or poorly efficient firms will be driven out of the market because nobody will buy their shares. And as a consequence of that is that they will disappear. So the process of buying and selling shares is a process of deciding which firms are the most effective, most efficient. Okay, we'll come to that, and we'll perhaps challenge that a little bit in a minute. And generating shareholder value is a solution to this, what we've referred to as the agency problem. What do I mean by the agency problem? Well, it's very, very simple in actual fact, is that the agency problem is that how do I, as the owner of the business, i.e. a shareholder, get you guys, the people that work for me, to work in my interests as opposed to your own interests? Yeah. So senior management of a firm might decide that really they could do with a company helicopter to help the chief executive go and play golf at the weekends, or take his wife and his family away, or parties, or whatever, you know, all of those sorts of kind of like managerial excesses, when actually that money should be spent or should be returned back to the shareholders, because after all, I'm the owner of the business, me and the rest of my shareholders. So we have this issue of agency, is that how do I get people that work in my firm to work in my interest, because I am the legal owner of the business, or I have a proportion of the ownership of the business because I have a shareholding. Okay, I have stock in the firm, which gives me that right. So the way that we resolved this, the institutions resolved this issue of agency and the agency problem was quite simple, is that you make management shareholders. So you reward senior management with share options. So effectively, you remove the barrier between the owners of the business and the managers of the business by making managers owners. And so therefore you try and reduce the agency problem. Now you might say that that's negated the agency problem, and we'll look at the evidence in a minute, but I think it's created different problems that we couldn't have foreseen when we started to talk about issues of agency and shareholder value maximization, and so on and so forth. So, isn't BlackRock a PE firm? Not strictly just a PE firm, no. It's a big fund. It does all sorts of different things. So, if we look at a stock, everybody's favourite, it's not strictly true, is it? Is that there is more than one smartphone. But everybody's laptop, I don't know. So you will see from the chart is that you've got quite a dramatic rise in share price. And you'll also see that I've stopped it at February 2015, and that's deliberate, right? It's not that I've not been bothered to update my slides since then. Is that it's deliberate, and I'll explain why I did it at that particular time in a minute. But let's think about the issues of management for a start. Is that this bit along the bottom, along here, this is the era of Steve Jobs. Now, Steve Jobs is reckoned as being, you know, some kind of like organizational managerial genius. Well, he wasn't particularly good for shareholders on that basis, because share price didn't really amount to a whole heap of much during the course of Jobs' tenure. There were some blips or some increases, if you like. You can see that in 2000, oh, don't want that. In 2000 is that you've got an increase in share price. That was as a consequence of probably the iPod. In many cases, before, ooh, was that before you were born, the iPod? You've been an iPod generation. That's interesting. But the old iPod in 2000 was quite a big thing, about the same size as a packet of 20 fags, cigarettes. But of course, you wouldn't know that because you don't smoke either. And it had a little wheel in it that clicked. It went click, 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 like that. So you get all your music collection on this one thing. It was brilliant. And well, we all thought it was brilliant anyway. As it turns out, it was pretty clunky and pretty antiquated and quite quickly. But nevertheless, increase in Apple shares at that time. And then you got the iPhone. I bought my first iPhone in 2008, which would be about there, which was the iPhone 3GS. Still works. Well, it would do if Apple supported it. But actually, it does work. It makes telephone calls, and I can still access the internet, but it can't do anything else on it because the iOS, none of Apple's apps work with the operating system anymore. But as you can see, slightly after that is that there was a drop in share price, which was possibly due to the iPhone 4, which was bloody awful. And then it rose again when the iPhone 4S came out, and it stopped burning your ears, and people started to buy them again. And then there was a drop off, and then back up again. And here was when Jobs was ill, and then so this tenure, or this share price here now, this bit where it's going up from here onwards, and it's continued to grow up and go up quite dramatically, is Tim Cook. So who's the organizational genius? Is it Jobs or is it Cook? Well, there's an argument for both, isn't there? I suppose. But certainly if you're a shareholder, you'd have to say that Tim Cook has returned you a damn sight more investment, or returned you a damn sight more value than Jobs ever did. And frankly, Jobs wasn't interested in shareholders. I think he felt that they were an inconvenience more than anything else. But I'd said something happened in 2015, February 2015, which is interesting. And this is the date that Apple issued a bond. Okay, so we've talked about bonds before, and banks can issue bonds. Anybody can issue a bond. I could issue a bond, nobody will buy it. That's the issue, isn't it? Is you can issue a bond provided that people will buy it. But you know, you could all issue a bond, but Apple issued a bond, and it was valued at about $4 billion. And they sold it for $6 billion. Now, when you put things out on the market, is that you've got to look at the risk that's inherent in the bond. So whenever something is sold on the market, is that there's a portfolio or a prospectus that's put together, and it identifies the risk. You go to the credit rating agencies, and they tell you what the risk is. Now, if you've read the materials this morning, you will have already worked out, or because I told you, is that the American government has never defaulted on any of its loans, any of its bonds issues. And it's rated currently at being AA plus, I think it is. Apple is rated at AAA. So actually, Apple is considered to be a more secure investment than the American government, which I find somewhat bizarre. The American government has got the monopoly right to create its own currency. Apple doesn't, although it does seem to be very good at making money, doesn't it? So, but by and large, is that people said is that, or the investment community said, is that Apple shares were very good value. You're going to get your money back. So therefore people bought them. Now, the selling of a corporate loan, corporate paper, a bond is not interesting in itself, but I think what is interesting is what Apple said that they were going to do with their money. In that Apple said that from the proceeds of the bond issue is that they were going to buy back their own shares. They were going to buy the shares back off the open market. So what's the net effect of the company buying the shares and there being less shares on the market? I've got a couple of questions here. I've got one. So why did stock price drop in 2013? Google it. Discounts the iPhone 5. All right, that's an answer to 2013. Okay, so that's why the share price dropped, because of discounts on iPhone 5. Thank you for that. Anyway, so what happens when you buy shares off the market? Well, let's assume that Apple, this is a very simplistic example, has 100 shares and each share is worth $1. Okay, so if Tim Cook comes in, well, the firm is worth 100, isn't it? It's 100 shares at $1, so the firm is now worth 100. So if the firm comes in and buys 50 of them, well, the firm is the same value. It's just now that all the shares are going to go up to 2. So in effect, by buying the shares, the share price increases. And this is a way in which shareholder value can be patriated from the company back into the corporation, back into its shareholders, as well as through paying dividends. Okay. Now, buying back of shares in big stock markets is actually incredibly common. It was illegal before 1985, but it's not illegal now. And it's very common practice. And it is a very efficient way of using debt or cash flow to reward shareholders. Now, there's another issue here as well in terms of why did Apple sell a bond when it could have used the vast amounts of money that it's got all over the world? Well, if it would have repatriated that money, it would have had to have paid corporation tax at about 31% on it. So it was basically, it was cheaper for it to actually borrow money and then use that money to pay back its, or pay interest to its shareholders, or to pass value back to shareholders. And what Apple does is that it's got a fund called Braemar that manages Apple's money over the globe, and Braemar invests in markets in order to make more money for Apple out of managing Apple's money. So Apple, whilst is a very sophisticated operator and manufacturer of phones, etc., 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 it's also a very sophisticated financial investor, financial agent. What was the basis for the legalization of share buybacks? Well, it was part and parcel of the deregulation of the financial industry generally. Right. Some bizarre reason is that this doesn't want to do anything anymore. And we're back on track. And Apple has continued to buy. Well, and it's worth pointing out is that 2015 was not the first time Apple had bought its own stock back. It was just the first time it had raised a bond to buy its own stock back. It had been buying its own stock back quite considerably. And again, you can see from 2010 onwards, or at the bottom of 2009 when Jobs was ill, is that Cook starts to buy back Apple stock. And they've bought stock back all the way through to 2018 to the tune of some 20 to 25 billion dollars worth of stock every year. So aren't Apple going to run out of stock? Not really. It's $1 trillion business. They've got plenty of stock to play with on this basis, and they're continuing to do it. I mean, this is a very poor chart. I'd like to have paid for the real one, but You could just see again in 2018, 2019. I think what's interesting here as well is that from 2017 onwards, it was when Trump did the his tax plan in America, which reduced corporation tax in the States from 31% to 20 something. Can't remember exactly what it was. But that meant that, broadly speaking, is that all of the giant corporations of America could now return their cash back to America without being penalised and paying high levels of corporation tax. And they use the funds to buy their own shares back again. So one of the interesting things is that you look at stock markets currently in an economy that is dive bombing and say, why are stocks so high? Well, part of the reason is that corporations are borrowing money and that they are buying their own stocks back, buying stock back. And the other aspect of it is that the Fed is creating huge amounts of liquidity for the financial sector, and the financial sector is investing money in stocks. And that is keeping stock prices buoyant, and through a process I'll explain in a minute. But this idea about stock price and stock buybacks, as I said, is very, very common currently. Now, I also talked about investors wanting high yields, and the yields come from, or the yield is the return that I get on my investment. Okay, so because we want the highest yield, but we also want the highest yield in the shortest amount of time, this has had the net impact of reducing the holdings of shares. In the 1960s, is that shares were held for around about 4.5 to 5.5 years. So if you take out flash trading currently, how long would you think that shares are held for? What would be the average holding of a share? Any idea? A few seconds. I say if you strip out the high frequency trading, a day, a week, 10 years? So some guesses going on here. A few months. A few months is probably closest to it, Johan. It's about 12 to 14 weeks. Because what happens every 12 to 14 weeks? Well, the firm has to go to the investors and produce an earnings report, or it's a quarterly performance report, it's earnings report. And on the basis of those earnings report is that analysts will say whether or not you should buy, you should hold, or you should sell the share. So if it's looking bad, is that the analyst will say sell the shares. And if you sell the shares, what do you think is going to happen to the share price? It will go down. So we started off with this notion of the agency problem, is that how do shareholders get managers to work in their interests? Well, the solution to that was to make managers owners. But that's created another problem, is that managers are now effectively delivering shareholder value for shareholders, but they're shareholders. So if you go back to Apple, is that any idea who the largest shareholder of Apple is? Microsoft. Microsoft holds quite a bit of debt. Other corporations' debt, they're buying debt, but no, it's not Microsoft. There's a guy called Arthur Ellison, who's the chairman of the board. Second biggest shareholder in Apple is Tim Cook himself. Tim Cook holds just short of, well, last time I looked anyway, it was just short, but very, very short of 1 million stocks in Apple. So every time that you get a 10% lift in share price or a 5% lift in share price through buying his own stocks back, is that Cook personally benefits from it. He also benefits from the decisions that are made about how you're going to distribute free cash flow. So every time that there's a dividend payment, Cook benefits from it. And at the moment, Apple are paying dividends 4 times a year, around about 12 cents on the share. So it's not a lot, is it? But that's 50 cents, say, over the course of a year, which is not bad if you've got 1 million shares. Quite a tidy bit of income. Okay, so what you've got is that you've got a concentration or a shortening of timeframes, because tenure of a chief executive is quite short. Cook's an aberration. He's been there for years and he's unlikely to be shifted. But by and large, most listed firms change their chief executive every 3 or 4 years. So if you've got share options in a company and you want to realize those share options in a company and you're only going to be there for 3 years, how focused are you really on the long term of that business, on product innovation and so on and so forth? You've only got a finite amount of cash flow in order to be able to spend, which you can spend on depreciation, but you spend it on R&D or you spend it on people and so on and so forth in order to be able to develop the business. But if you don't look after your shareholders, they might well decide that actually they put pressure upon your board in order to try and terminate or to remove and replace with somebody that's more proactive in managing shareholder value. So whilst it's resolved this notion of the agency problem, it's created this other problem of short-termism and the proportion of increasing proportion of free cash flow that goes towards shareholders as opposed to the actual fundamentals of the business itself. And that is an issue. So let's just look at this as an example and ask some questions about this as an example. This is just some bog standard stuff from the car industry. Okay, so you can see at one end is that you've got General Motors who make and sell about 3 million cars a year. And then at the other end, you've got Tesla of 43,000 or just short of 44,000 cars sold globally on an annual basis. Now, I haven't got the figures for General Motors, and actually they did something quite interesting that I'll talk about when we talk about business ethics towards the end of the program. So I've used Ford Motor Company. Ford Motor Company sell 2.5 million cars a year, which amazes me really, but they do. They sell 2.5 million cars a year. Comparison to Tesla's 44,000 cars a year, but whose firm is worth the most amount of money? Who's got the highest market cap? You've guessed it, it's a loaded question. Okay, it is actually Tesla. Tesla is worth 47.8 billion, whereas Ford is worth 44.3 billion. Now, my question is, what exactly are people buying here? Because Tesla's never made any money. It makes money periodically in Q3, but then loses it all again in Q4 because it takes pre-orders and then reality kicks in and Tesla burns through cash, millions of dollars worth of cash every year, and it doesn't make any money. So what are people buying? How come Tesla's share price is, or Tesla's value, the corporation is valued more than the Ford Motor Company, which makes cars? Now, you look about, I mean, Tesla doesn't make any money as well, but it's actually not managed by people who are from the car industry either. Elon Musk has got no experience at making cars. He made his money in PayPal, in finance transaction, internet transaction software. So what are people buying? Prospects of what? Why are why when a firm has never made any money, surely its prospects are it will not make money. At what point are you deciding, well, it's going to make money sooner or later? So as an investor, if you were working for my investment fund and you said, well, I'm going to invest some money in Tesla because it's going to make money sooner or later, I'd say you need to really think about what you're doing here, or you can go and collect your cars and go and find another job, because that is not a good reason for you to invest our money in something that might happen. And when is it going to happen? What time frame are you talking about? It's betting on the future of renewable energy with electric cars. How long for? That'd be ridiculous. Of course it's not. How can they be? How could a professional investor and an investment firm say, well, we're betting on the future technologies? How would they know? How could they possibly know? The future is uncertain. Nobody predicts the future. All you can do is extrapolate from the past into the future. Tesla doesn't make money. Will it make money next year? Well, it doesn't look like it. Well, when will it make money then? Surely if you could predict the future, Maya, you wouldn't be on this course. There'd be no need for it. Surely the response perhaps might be, let's look at it in a different way, in that if is that people are investing in different things. They're investing in the yields and the value that can be extracted or can be taken out of Tesla. If there is a view that Tesla's share price is likely to go up, then maybe investors will be backing on the fact, or betting on the fact that, or on the potential that the share price is likely to increase, and they will make money on that, which suggests that there is a disconnect between share price and the underlying fundamentals of the business itself. And that is explained by the fact is that investors are not backing companies on their profits and so on and so forth. They are buying shares on potential yields. And corporations are also competing, therefore, with other corporations in stock markets rather than in product markets. And that's relative, clearly. Selling goods and stuff still needs to happen, but the firm is focusing upon delivering shareholder value to its share prices. Well, yeah, Tesla's. Well, if Tesla overvalued, you're making a judgment based upon. You'd need to understand why people are backing Tesla shares. If you think that Tesla shares are going to go up, then no, it's not overvalued. If you look at it from, let's look at the ratios and so on and so forth and make calculations and this, that, and all the rest of it. If you look at it as say, well, why is a firm worth $47 billion that actually doesn't make any money? Then yeah, it is overvalued. But that doesn't seem to have much of an impact upon its price. The argument for buying Tesla shares is it's going to go up. That will be the argument. And Tesla shares have done very well. They could have done better if actually Elon Musk was not such a maverick. Is that he might well have produced higher returns. And bad press about Musk's behavior. I don't know if you remember, but he was caught doing an interview. It was an online interview, so it wasn't technically supposed to be filmed, but it actually was captured. And they released the video after the interview. And Musk had been smoking a joint whilst answering questions. Whatever you do in your own home's fine, but doing it in front of the TV or when you're being filmed and you're talking about Tesla businesses is probably not a wise move. And they were, there was all sorts of issues that's in there, and you can read through that in a way. But so, what I'm suggesting here is that actually the reputation of Musk has an impact upon share price, just as it does with Alibaba and Jack Ma, even though Jack Ma is no longer involved in the Alibaba business, and Tim Cook, and so on and so forth. That's quite interesting in that there's sort of like the celebrity CEOs are able to construct share prices or extract value for share prices on the basis of things that they say. Now, it shouldn't surprise anybody really, because if you think about it, earnings report in quarter one is that I'm a chief executive and Zoe's my financial manager. And as we're walking into the meeting, we'll have done a bit of work before, and obviously won't be Zoe. We'll have had a coffee before. And so what are we going to talk about? But Zoe is the head of finance, will have said, well, we could talk about margins. Margins are really good. So we go into the meeting, we see all of our analysts and our investors, and we say, good news, everybody, margins are at an unprecedented high. Everything's looking rosy for the future. And somebody might say, that's very interesting, Mr. Evans. What about revenue? And I say, margins are up, they're unprecedented, and they're going to be very high, and everything's looking rosy for the future. So it's not like you're not telling the truth, but you're not likely to go into a meeting with your investors and with your analysts and say to them, do you know what, we've had a real bad quarter, because what's going to happen to the share price? So, but you know this because as you start to work on your CVs and you go out into the big wide world, is that you'll focus upon the things that you want the other people to know. You're not going to tell them everything. That would be dangerous, wouldn't it? So it's not the case of you not telling the truth. It's the case of you wouldn't like to draw people to your Facebook profile where there's the stuff in it that you're not quite sure that you like people to see. Yeah, you're going to direct them to the stuff that you would like them to see. That's what a CV is. Everybody does it. So we know this. We know that people will focus upon things that have an impact, things that are going to make a positive series of decisions based on our business. Okay, and so what chief executives effectively are doing is that they're explaining the differences between the expectations of the market and the realities. As if the underlying economy is growing at 2 or 3%, but analysts are saying we're expecting 10% growth out of this company. Is that realistic? I'd argue it's not. So even if you get, I don't know, 3.5%, you buck the trend of GDP, you grow faster than that, you're still never going to get near the analysts' expectations. But you can explain it and you can come up with a coherent story, a coherent narrative, which would suggest that the firm is still a good investment in terms of share price. So it's less about the fundamentals of the business and it's more about the capability of senior management to tell a good story about what the future is going to look like, and so on and so on and so on. People buy Tesla shares because they're going to rise. Creates a self-fulfilling prophecy. Talk about that in a minute. It's not incorrect. So as the change in which stocks are being valued changes the landscape for value investing. Well, I think I used to work in London in the when would it have been? Mid to late 1980s, right? And the city of London had exploded, and if you went into the city of London around the markets and of London on a Friday lunchtime, you would have seen traders out enjoying themselves, shall we say. And the people who had made a lot of money at one end of the bar drinking expensive champagne, and the people who hadn't made a lot of money at the other end sharing a pint of lager. And so very quickly is that if you're in that confined space, what do? Well, you go, well, we're sharing a pint of lager, they're drinking all that champagne. Go and find out why. So you go over and you're going to talk to them and say, had a good week, have you? And they said, yes, we've done brilliantly. What have you been investing in? We've been invested in securitized mortgage-backed securities. Don't worry about what that is. I'll explain that another time. But we've been investing in mortgage-backed securities. You go, oh, right, oh, that's very interesting. So you go back to your mates and where's my lager? Oh, you drank it while I've been away. Thanks a lot. So they said, what they've been investing in? Well, they've been investing in mortgage-backed securities. No. Do you think we should invest in mortgage-backed securities? Yeah, probably. Should we go back to the office and do some more work? Yeah. So everybody trots off, and you back the mortgage-backed securities. Okay. Is that the market follows the market? Makes sense, doesn't it? Really. So you can stay in your office and you'll do your variance at risk calculations and you'll do your black skulls and all the rest of it. But at the end of the day, you'll go, what do you reckon? What's everybody else doing? And then you'll take a guess, an educated and an informed guess about the investment that you're going to make. And if you're really smart, then you'll try and hedge it in one way or another. Okay. But to say that, and I know that the theory suggests that markets are efficient and that, the market price, the idea about the market price, the price of a stock, is it tells you everything you need to know about the company. Well, I'm suggesting that's not quite the case. I think there's other things that are considered in practice and in realities. And at the end of the day, investors want their yields. Okay, we'll come back to this as we go through it. Now, you will know that chief executives get paid a lot of money. Well, they get paid a lot of money in order to be able to return value back to shareholders, in effect, because we're rewarding them with shares and so on and so forth. But stock markets went up between, what date have I given you? 2016 to 2017 is that stock markets grew by 14%, which is the figure on the right, but chief executive salaries grew by 17%, which is just over a year, just in 1 year, which is So they're not being paid for realizing the value on the stock market. They're getting more than that. Private sector workers' salary grew by less than 1%. The chief executives went up by 17%, and private sector workers on what is it? It's an average, I think it is. So they grew by 1%. So the money goes to the top because the chief executive's doing all the work. Really? Because the idea is that your salary equates to the amount of value that you produce in an economy. Chief executives produce more value. What do they actually do on a day-to-day basis? And if you actually look at the percentage difference, is that now chief executive salaries are now 300% larger than average workers' earnings in the private sector. Now, there have been a number of studies trying to understand how chief executive salaries equate to performance, and they can't find any. There is no correlation between performance of businesses and chief executive salaries, apart from the size of the firm. Bigger firms attract bigger salaries and bigger deals and so on and so forth. But that's it, which is, again, interesting. Now, there are institutional investors that are saying that, standing up at board meetings and saying, this guy's being paid too much. We vote down his pay increase, which is effectively what happens in terms of the annual meetings and so on and so forth. By and large, institutional investors will say that we're not going to vote, as opposed to they will vote against it. And that's considered to be a protest vote. But again, what are they protesting about? They're protesting about the fact that a chief executive is being paid too much money based upon what? Well, only based upon the fact that you've not returned me my investment on you've not returned back to the shareholders. So what they're suggesting is that actually we'd like more shareholder value. And these are the same people that are criticizing the shareholder value notion in the first place, like BlackRock and its like. So it's a financialized system which is extracting value out of corporations for the benefit of shareholders. They're the owners. Then the justification will be that they're the owners of the business. But on the other side of that coin is that you've got to think that there is this belief that actually the markets are making the firms more efficient. I suppose you could ask efficient at what? If it's efficient at extracting shareholder value, then yeah, they'd be about right, wouldn't they? So investors search for high yields. And as I've just indicated through looking at Tesla as an example, or corporations as an example, is that yields can be generated by stories, by narratives, as we call them, rather than the economic fundamentals. And there's some examples there: Asian tigers, the new economy bubble, financial engineering of credit risk and the subprime bubble, which we'll talk about more specifically in a lecture which is devoted just to the financial crisis. The BRICS as challenges, I like this one, so we'll just spend some time talking about the BRICS. Who are the BRICS, or what are the BRICS? Brazil, Russia, India, China, and South Africa, I think it is the last one. It's the emerging markets, yeah. People know what the BRICS are. And I showed you some figures in the materials this morning, is that the emerging markets are developing have a greater share of GDP. Although, actually, if you looked at Brazil, Russia, India, and China, and South Africa currently, is that perhaps not performing as well as they once were. But nevertheless, who invented the notion of the BRICS? Somebody must have created it, crafted it. Anybody any idea about who invented the notion of the BRICS? You probably won't do. There's no reason why you would do, because you wouldn't cover this anywhere else. But it's actually Goldman Sachs, the investment bankers firm, the investment bankers, Jim O'Neill. Is that Goldman Sachs created a narrative to say that all of the growth is going to come out of the developing world. These are the biggest pioneering economies. You should be investing in them now. conveniently is that we have an index that you can invest in which will do exactly that. And as a consequence, they invest in the index, and the indexes invest in the shares, and so on and so on and so forth. Just as a question as an aside, is that when you buy a share, who gets the money? Yeah, whoever you bought the share from. So some people think that by investing and buying in stocks and shares is that you are actually contributing capital back to the corporation itself, and that's not the case. That happened when they sold their stake in an IPO, initial public offering. Then they would have got capital that came into it, but subsequent to that is that you're buying the share off the existing shareholder. So it's whoever owns the shares, the shareholder gets the benefit rather than the corporation itself. So if what you're doing is that you're investing in an index of shares which are based upon the markets of Brazil, Russia, India, China, wherever else, is that you shouldn't be surprised that once you invest into it in a substantial form, is that that market will go up, because nothing new is created. So all you're doing is investing in the price. And if you put a lot of money into the price of something, then the price inevitably goes up. It has to. It's just, yeah, it doesn't matter. And if you take money out of that market, then the price of the market will go down, because nothing new is created. So narratives, therefore, like O'Neill and the bricks, generates yields. And the more persuasive the narrative, the higher the yield is possibly. The digital economy currently is another narrative developing a yield, in that since 2008, more than 50% of stock market gains have been on a few tech companies, what's known as the FANG companies, which is Facebook, Amazon, Apple, Netflix, and Google. That's where the bulk of the growth in share prices come from. There are other companies that are listed in the S&P 500 that hardly grown at all, despite the fact that, you know, it's been a bull market. And let's just take an aside a little bit here and talk about narratives, because in academic terms, narratives, stories, discourse, all the same thing, okay, but we tend to call them narratives. Is that narratives have the capacity to perform the market. What does that mean? Make things real, make things happen. Now, there is an idea, isn't there, within business that actions speak louder than words. Well, actually, if narratives perform the reality, then they don't. The words are actually more potent than the actions in itself, or the capacity to be able to tell a good narrative and craft a good narrative. And an economic, yeah, he's a sociologist, I think, French sociologist, Jean Calon, wrote quite an extraordinary work that said that economic discourse performs the economy. In essence, he said that really what economics does is it makes the economy happen in a way that the narrative says that it's going to happen. So laws of demand and supply can be applied to economic problems because that's what we expect to see. And our narratives make things happen in a way. But he describes all economics as being a narrative. Now, that's a bit of an extreme position, but we don't need to discredit it just because that just strikes as being a bit extreme. Is that perhaps we should give consideration, is that rather than trying to extend our models of perfect equilibrium so that the data fits the model, perhaps we should be looking for alternative explanations. And where we've looked at narratives is that we've found much more credible explanations rather than the demand and supply. And if I give you an example of that, is that a few years back, oil prices were at $120 odd a barrel, and virtually overnight they crashed to $30 a barrel. And the reason that was given for that was that the oil was oversupplied. Oh, that makes perfect sense then, because the supply curve is shifted and there's a correction in price and so on and so forth. Makes perfect sense. apart from the fact that you just really need to ask some questions about that. Because my first question when somebody says, well, the oil market is oversupplied is, didn't you know? Well, you're a professional manager that works in the oil industry and you didn't know that you were oversupplied to the extent where the price of your oil crashed down by 75%. What kind of managers are you therefore? Did somebody go out to work one morning and decide to take the flip chart and count all the oil and say, oh, we've got too much? Perhaps we ought to inform the market. It doesn't sound likely, does it? If that was the case, then cars should be crashing through the floor as well. Because if you drive past a car manufacturing plant, there's loads of cars sitting outside the front of the factory, not polished yet, but finished, supplied, oversupplied. In fact, virtually every product on the planet is oversupplied, but I don't see the price of the Volkswagen Golf crashing through the floor. But oil, oversupply, they said. Perhaps a more realistic and believable solution to that might well have been that commodity traders believed that the price of oil was overpriced and they started to sell it. And then once you start to sell something, is that you don't want to be left holding something which is now worth less than you bought it for. So you sell too. So you sell and sell, and you end up with a fire sale. Because the last thing you want to do is everybody's selling oil is be the one that's left with all of the oil, which is overpriced, because you just lose all of that money. And that seems to me to be a much more sensible description of what's likely to have happened, as opposed to it being, well, there's an oversupply and a market correction. So economists contribute to these narratives, as I say, is that according to Calon, is that economics can be seen as being a narrative, because economists are inventors who fit into the innovation process. They're immersed and embedded and work within an economy. But they're also describers who produce concept theories and tools and who stand back and they observe and they write about the economy. And in many respects, they're writing about their own innovations. So how can it exist as a description and also contribute to it as well? And what basis are you doing that? There is a paradox that's in there, in that you're in effect writing about the sophistication of your own innovations and demonstrating and proving that they work. And that is a challenge, I think, to economists who are not objective or are not objectively looking at the realities of which they're supposed to be theorizing, which is why we take this position of looking at the ground floor and looking at what's observable. And that brings me on to what's known as a halo effect. Now, I can't remember if I've put the book on your reading list. I will check, make sure it's there. The halo effect is, to my mind, an important book. It's there you go, the halo effect. I have a copy, look, by my desk, as it's a new one. Look, it's not been looked at, that one. But the halo effect is that, what is it? Is it so many of the things that we managers, journalists, professors and consultants commonly think contribute to company performance are often attributions based on performance. The price of Tesla is an example of that. The halo effect is a way for the mind to create and maintain a coherent, consistent picture to reduce cognitive dissonance. The halo effect, crafted by stories, is too strong. The desire to tell a coherent story too great. The tendency to jump on bandwagons too appealing. Somebody said self-fulfilling prophecy. And that's in essence what's happening here. And in the book, he talks about a series of delusions. And there's a delusion of organizational physics, which implies that the business world, markets, offer predictable results, conforms to laws, fuels a belief that a given set of actions can work in all settings and ignores the need to adapt to different conditions, claiming that one approach can work everywhere and at all times for all companies, a simplistic appeal, but doesn't do justice to the complexities of business. It is complex, it is uncertain. Go back to the first session when we talked about the different perspectives of uncertainty, and I introduced you to Keynes' view of uncertainty. The future is not known. You can only calculate the probability of something that is known. It is very challenging, therefore, to calculate the future. You can have a good, accurate guess, but there are other things that come in there as well. in order to help us. But halos are this idea about people jumping on the bandwagon. So let me give you an example here. Is that this is Northern Rock, so and it's a depiction. It's a graph of Northern Rock's balance sheet in 2006. Went bankrupt in 2007, by the way. There was a run on this bank. That was the last bank, or well, it wasn't the last one, but it was a run on the bank, and the government stepped in and nationalised it, split it into two, and it took all the bad debt and put that onto the central bank, to the public domain. And it sold off all the good debt to that nice Mr. Branson, and he created Virgin Money. Now, so this is Northern Rock. Where is Northern Rock? Where was Northern Rock's locus of operations? Well, it was a big bank. It was based in Newcastle, and it probably came all the way south to York. I think that was probably about as far as it went. So it's the northeast of England. For those of you that don't know or are not English and don't know them, you're talking probably about 120 miles due south of its office. And that was its global outreach. But look who's making these statements about Northern Rock. This is JP Morgan, for goodness sake, one of the biggest investment banks on the planet. And in 2006 is that JP Morgan said Northern Rock has managed to transform itself into one of the UK's top residential secured lending powerhouses, mortgages in other words. We expect asset and profit growth to continue to outpace the market, and Northern Rock is the envy of its peers. You can see where they're making the money. It's the pink bit on the graph, okay? Securitized notes. I'll give you a definition of what securitized notes are, or securitization was in the lexicon on finance. But basically is that Northern Rock was selling mortgages to people in and around Newcastle in the northeast of England, but they're not the best customers in terms of credit risk. So they were selling, not subprime, but they were selling quite risky mortgages and then securitizing it and turning everything into derivatives and selling that into secondary markets. So go back to the idea about if you're in a bar in the city of London and there's people all over there with champagne, and you find out what they're doing, and they say, oh, perhaps we ought to do that then as well. So once JP Morgan released this and say that they are a residential secured lending powerhouse and the envy of its peers, how many other people said, you think perhaps we ought to be doing that? The narrative's too strong, isn't it? But it doesn't tell the whole story, and it didn't tell the whole story about Northern Rock. But the chief executive at the time, Chuck, what's his name? Citibank. He came out with this. I'll try and find the proper quote. He came out with this lovely quote, which he said, "When the music's playing, you get up and dance. Everybody's buying and selling mortgages. You join in." And he said, "We're still dancing," and they still carried on buying and selling the mortgages, because if you didn't, there was a fair chance that you were going to get left behind. So there's more of a pressure to actually follow the notion of what's going on, follow the crowd, as opposed to being the outlier. Now, there were outliers, and we'll talk about that at another time. But the point that I'm making here is that the narrative related to the halo is just too strong, and people get caught up in it. Keynes called it the madness of crowds, I think, or the herd mentality, or something along those lines. No, it wasn't the madness of crowds. That's somebody else. Don't forget that. I didn't say that. Do you get the point now? Anyway. So, and then our view is that fintech is another narrative. Now, fintech changes really, really quickly. And the fintech markets, in terms of new products and so on and so forth, do show quite interesting developments. But there's very, very little value that's been extracted out of, or very, very little value that's been generated by any fintech firm at the moment. And fintech as a word, highly efficient, combines finance and technology. And this is about Funding Circle, and Funding Circle are failing because it can't raise enough money. So it's more about the availability of finance and the technology. But rather like Tesla, we're focusing on the technology, and people are investing in the technology or the potentials of the technology, or claim that they are, but in actual fact is that they're investing in the yields that can be returned. So at the bottom it says the availability of finance and not advances in technology that determine its performance. And if you look at investments in fintech businesses at the moment, is that all of the money is being invested in payment transaction, not cryptocurrencies or anything else along those lines. It's almost all exclusively payment transactions. It's all about the finance, not about the technology. But hitherto is another a narratively driven bubble. I'll give you an example about that. Is that in the 1930s, there's a very famous story from, I think it's Rothschild, who says that when the shoe shine boy, i.e. the person who shines your shoes, gives you financial investment advice, it's time to get out of the market. Well, this really happened to me in Manchester. Is that I got in a taxi in Manchester, and the taxi driver asked me if I was investing in Bitcoin. And he said his brother is investing in Bitcoin, and he's a millionaire, he said. I said, all right, so he's given up work then. He said, no, he's still driving a taxi, which I think was a bit odd. If you're a millionaire, you're still driving a taxi. But is another truism is that when somebody starts giving you financial advice about buying Bitcoin, it's time to get out of the market. And not surprisingly, a few days later on, the market price of Bitcoin collapsed. People invested quite a lot in the value of Bitcoin, but it doesn't do it. It didn't do anything. There's no value that's generated out of it. Nothing new is created. You're invested in a stock, a fixed stock of something. The price has to go up. So values and narratives. Okay. So the concluding remark that I would give you is that this idea about shareholders and value extraction and markets really needs to be looked at. And I said when I did the last lecture like this, is much more from a cultural perspective, in that the cultural perspective looks at the underlying narratives and their capacity to perform the market. And very often, the capacity to be able to explain what's going on is much better than the orthodox economic thought. And we'll continue to pick apart those as we go through the lectures and the learning materials over the next few weeks. Okay. Not bad, hour and 20 minutes. So, have we got any questions?
My question is,
Yep.
like with
Who's talking?
Malak.
Malak, hi.
Hello.
Go ahead.
I wanted to ask about if when we're gonna take the MCQ exam, like how are we supposed to study for these lectures?
On the what? Sorry, you've got a question, but it's not about what we've just talked about. It's about the exam at the end of the...
Yes.
Well, it's a multiple choice exam.
Yes, I mean, how should we, like for the lecture we took today, should we just study the notes that we took?
Well, I think that would be a good start, yeah. I will post the two previous examinations probably before the end of this week for you to have a look at. And